Okay, great, great. Thank you, Teresa. Okay, so let's see. Okay, I think we can go ahead and start then. As I said, our program tonight is being led by the wonderful Jessica Medina. So Jessica, if you would like to let everyone know about yourself, and if you want to go ahead and start, then
Great. Well, thank you everyone for joining. I have seen some familiar faces out there, which is wonderful to see. And it's great to be back with the Alexandria Library for another presentation on fascinating financial topics. Tonight, we're going to be talking about student loan repayment options. One thing I do want to mention, this is being recorded. So if you miss something during the presentation, there will be a recording available. And you can drop a note in the chat to Allison that you would like a copy of the recording. Also, if you have a question while I'm talking, I have a tendency to go on and on because I have so much information to cover, but just pop a question in the chat and Allison will stop me so that we can try to get it answered. Just a couple of disclaimers for today. This is going to be general information, and you always are going to want to go to an original source like studentaid.gov to make sure that you're getting the best and most up-to-date information, since things are constantly changing, especially in this environment. Also, I may not know the answer offhand. If you have it, of course, I'll try to answer, but I will know where you can find more information. So I'm absolutely trying to be a resource today, even if I can't provide you a specific answer to an issue you may be having. And finally, we will be talking about some strategies that affect taxes. And so I want to make sure that to the extent that you are interested in implementing any of them, you definitely speak with a tax professional, because although we can give advice on student loan repayment, your entire tax profile is something that should be looked at in a holistic way by a tax professional. But let's get started. So today we're going to be covering the state of student loan debt. I'll be giving you some information which you guys are probably aware of, especially if you're feeling the stress of it. Student loan basics, we'll talk about all of the repayment options for federal and private loans, what happens when you go into student loan default, and then I'll be providing you some resources to help you find more information and get more guidance in paying down your student loans. And of course, you can always ask questions during the presentation. So who should be here today? Any graduates who are in your repayment phase. And when I say graduate, I'm a graduate. I graduated over 15 years ago from law school, but I'm still a graduate and I'm still paying down my student loans. Anyone who is a near graduate about to enter repayment, they would find this information useful. Parents who are paying off loans that they've taken out to help their kids go to school. Anyone interested in transitioning careers where you're going to have a real change in income, figuring out your repayment options can play a really big role in making sure you have good cash flow no matter where you're working. And anybody who's stressed about student loans, hopefully the information you're going to get today is going to relieve some of that stress and give you some strategies to move forward. So just a little bit about me. I am a practicing attorney. I am a financial counselor and coach #1 though. I've been a licensed attorney and practicing over 15 years here in the DC metro area. I spent 8 years at a large DC law firm and then the last 5 at the Securities and Exchange Commission. And I am a candidate to become an accredited financial counselor. So there are a bunch of different types of financial counselors out there, but I'm one of the ones that will hopefully go finish through the certification program. And part of this helps me get all my practice hours in. So thank you, Alexandria Library. I'm also a mom to twin teenagers, which doesn't have so much to do with the financial counseling and coaching, but it does have to do with the juggling and the managing and everything else that goes along with life. So first off, student loan debt is the second largest form of debt for Americans, right behind housing. So if anybody is feeling stressed, I want you to know you are not alone in this. Also, I have a philosophy that people need to address their debt in whatever way feels most comfortable for them. So some people are very adamant about paying it off as quickly as possible. Other people are pursuing forgiveness in different types of programs. And as a financial counselor and coach, I don't believe that it's my job to tell somebody that there's only one way to do everything. So what I do with my clients is we sit down, we talk about it, we talk about how they feel about their debt, what their goals are in their life, and we figure out a plan that works for them. And not every plan works for every person. And what I would ask is, to the extent that you have questions, that we leave the platform open for people to feel different ways about it. So a little bit more about that student loan debt. Oof, we are up at $1.64 trillion across the United States. The large majority of that is federal student loan debt, which is what we're going to be spending the majority of our time today talking about. That's up at above $1.5 trillion. There's 42.8 million federal student loan borrowers. So like I said, you are not alone if you are still paying federal student loans. And in terms of the borrowers in default, we have over 3 million. So there's definitely an issue in terms of being able to either pay or manage this immense debt that our entire country is under. And I'm hoping that some of these repayment options will help clarify things for everybody. The average student loan debt in the United States hovering around $35,000, and Virginia is pretty typical for the area, $37,000. I know I saw some slightly higher numbers in Maryland, and a lot of that just has to do with how much schooling people have had, but we're right there in the average, and it's still more than your typical car on the way to, you know, one of the biggest debts that you might be carrying in terms of your lifetime. So let's go through some basics. There's generally just two types of student loans. You have the federal loans, which are owned by the US Department of Education. And because the Department of Education has had so many different student loan programs over the years, that's why you see so many different names of everything all over the place. And only certain programs apply to certain types of loans, which is why it's really important to figure out what type of loan you have so that you can find the right repayment option for your loan. So like I said, the federal loans are all owned by the US Department of Education. You have things like the direct subsidized and unsubsidized. Subsidized and unsubsidized refers to whether the interest accrues while you are in school, or whether the federal government will cover your interest during certain periods of time. So if they're subsidized, that usually means that the federal government will cover the interest while you are in school or in a forbearance period. But if they're unsubsidized, that means that the interest just keeps building on top of the loans, whether you're paying them or not. Direct Plus are special types of loans for parents and also for graduate programs. Direct Consolidated is a consolidation loan, and we'll be going over exactly what that means a little bit later in the presentation. An earlier program, before the direct loan program was created, was the Federal Family Education Loan, also known as Stafford loans. So if you see on any of your statements or in your documentation FFEL, that's part of that program, which is now defunct. And then there's also your federal Perkins loans. There are also private Perkins loans, which can be a little bit confusing, but that's why it's so important to make sure that you know exactly who owns your loan. And the way that you can figure that out is by going to studentaid.gov. The federal government and the US Department of Education in particular has finally done a pretty good job of putting together all of the information about what kind of student loans are available, what repayment options are available, what you can do to help manage your student loan debt, and just because there's so many different programs, giving you all of the little nuts and bolts of all the different programs and what they apply to and when you should consider them. So it really is a fairly good website. And you know, as government websites go, sometimes they can be a little hit or miss, but studentaid.gov is a wonderful resource, and you should always start there if you even think that you might have some federal loans out there. Even if they're in default, they will be on that website. Separately are the private student loans. So that's every other student loan that is not owned by the federal government, we call a private student loan, which means that it's basically owned by a private lender, whether that's a bank or even a college in the case of Perkins loans. With the private student loans, they're going to be owned and serviced by private lenders, and you're going to need to check your student loan statement to figure out who your servicer is and who owns your loan to confirm, number one, that it's not owned by the US Department of Education. But also you can check with, if you're in collection right now, check with the debt collector of who actually owns your loan so that you can start negotiating with them. You can also check your credit report, and that should have some information about who owns your loan, especially if it's in collections or in default, and it will give you some information about who you can contact to get some more information about those private student loans. So that's the universe, federal and everything else. Now, thankfully, like we saw, 1.5 trillion out of the 1.64 trillion is federal loan student debt. So that's why we spend so much time talking about it. So starting to go through some repayment options. Let's take it piece by piece. We're going to start with the federal loans because there are so many programs that are offered by the federal government to help you repay your student loans. The first is the standard repayment. That is a 10-year plan with fixed payments. It is the default plan that you get stuck in as soon as you graduate. So if you don't sign up for any other program or talk to your lender about trying to get into any other loan repayment program, you will automatically be put into the 10-year repayment plan. For many people, the monthly payments on a 10-year plan are prohibitively expensive. If you can think about, gosh, as a law student, I had hundreds of thousands of dollars of student loan debt that I graduated with. I don't know that I even looked at what the 10-year payment would have been because it was absolutely not an option for me. And I was a lawyer. So I was in one of these alternative payment plans. But for many people with regular jobs, depending on how much you've taken out, trying to pay everything off on a 10-year schedule is really aggressive. And so that's why standard is what you get stuck into and it's your default, but it is not where you need to stay. There are alternative repayment plans for some of the older loans. So before they came up with the really good plans that they have now, they had plans that were called extended repayment or graduated repayment. Those programs would give you extra time to pay off the loan and also might gradually increase the amount of your payment over time. So for example, with graduated repayment, you could sign up for 20, 25, a 30-year term for your loan. And on top of having all that extra time, the payments would be smaller in the beginning when you're at the beginning of your career and then larger toward the end when you're supposed to have, larger income. So that was kind of the old standard of the repayment options that were offered by the federal government. Nowadays, you have what are called income-driven repayment plans. These are very robust and very reasonable payment plans that are completely based on your income. So they figure out what your monthly payment is going to be based on your income and the number of your family size based on your tax filing. And that gives you some indication of what your monthly payment could be. And in some cases, it may be zero. If you don't have enough disposable income, then they're not going to require you to pay anything. And on top of that, with these income-driven repayment plans, because they literally are supposed to be a reflection of how much money you're bringing in, once you've been in those programs for anywhere from 20 to 25 years, depending on the program, your entire balance can be forgiven. Now, it's a wonderful, wonderful gift. It can be, a wonderful relief off of your shoulders, but there are consequences to forgiveness, and especially through the income-driven repayment plan. And so we're going to go through what some of those are as well. But those are, generally speaking, the three different types of repayment options that you have with federal loans. And now you just have to figure out, well, which ones are going to be the best for you, for your current income, for the trajectory of your income, and everything else that you have going on in your life when you're trying to work through these repayment options. So these are the income-driven repayment options that are available. As I said, there have been many iterations of federal loan programs, federal loan repayment programs, and that's why it's really important to figure out exactly what type of loan that you have, because certain programs are not eligible for certain types of loans. So going through from oldest type of plan to newest type of plan, the income contingent repayment was kind of the first thing that they came up with after they were done with extended repayment and graduated repayment. Those programs are actually still available for loans, but income contingent repayment was the first kid on the block with dealing with income-driven metrics to try to figure out your payment. So income contingent repayment applies to all federal loans. So it doesn't matter when you got it, and it doesn't matter how old it is, or whether it's an FFEL or a direct loan or a direct consolidated, you can always get ICR. There's a 25-year payoff. So if you're in the ICR program for 25 years and making payments, whatever those payments are, then after 25 years, you can get forgiveness for the balance of your loan. It's based on 20% of your income, but not on your gross income. There's a formula. The formula is on studentaid.gov. There are calculators on studentaid.gov. It's not really useful for me to take you through a formula right now, but you can put in your own numbers and figure out exactly what a potential payment could be for you, given your student loan balance and your income and the number of people in your home. But it'll be something in the range of 20%. One of the issues with the income contingent repayment plan is that there is no cap on what your payment can be over the course of your repayment schedule. So if, for example, you get out of college and you have thousands and thousands of dollars of student loans and you go and work for a nonprofit and you're making close to nothing, so your ICR payment is close to nothing. And after 5 years, you've been making close to nothing payments. Your loan balance has basically been increasing the entire time because you haven't been making payments to even cover the interest. And then you get a baller job as an executive now running a for-profit business. They're paying you a real salary. You have more money than you could have ever dreamed of. You're still going to have a 20% of your income monthly payment. And that payment could very well be more than your payment would have been under a standard 10-year repayment plan. So that's one of the dangers of this ICR program in particular. So if you know that you're going to have, low income for most of your career, then it might be an option for you, especially if you have older federal loans that don't qualify for some of these other income-driven repayment plans. But that's one thing that you want to watch out for. So the next baby in the line was income-based repayment. This also applies to all federal loans except Parent Plus. So if you have a Parent Plus loan and it got consolidated in with your other federal loans, that's something to be careful of. But most of these do not apply to the Parent Plus loans. Similarly, it has a 25-year payoff schedule. This one is 15% of your income. So if the size of your monthly payment is really important, this could be a better option, right? If you're balancing, ICR, IBR, 20%, 15%, same payoff schedule, seems like only having to pay 15% of your income is better. One of the requirements, though, is that there does need to be some sort of financial hardship, meaning that you do not have enough income to cover the 10-year standard repayment. There's no financial hardship requirement for the ICR program. Also, in the income-based repayment program, the IBR, there is a cap on the payments. So you will never pay more than you would under the 10-year standard repayment plan. So in the scenario that I painted earlier, where you have a low salary in the beginning of your career, but at some point you transition to having a much higher salary, you'll never go above what the payments would have been on the 10-year standard plan. So there is at least a cap, and that there's going to be a maximum that you're going to have to pay every month. So after IBR, they came up with PAYE, P-A-Y-E, pay as you earn. And it's exactly what it sounds like. This is for direct loans. Direct loans were kind of the new kid on the block at that point. This was after the FFEL program ended. And they had these new types of loans, and they wanted to come up with a new income-based repayment plan for them. So it only applies to direct loans. If you have some of those older loans, you cannot use the PAY program. Also, it doesn't apply to Parent Plus loans. And this one has a 20-year payoff schedule. So that's the next 5 less years of payments that you need to be making under this plan. And the payments are only 10% of your income. So this is really the lowest percentage available under any of the repayment plans. But again, it requires a financial hardship. So you basically just have to prove that you can't afford to make the 10-year standard repayment, and then you can get access to this. But it does, as I said, this was one of the more recent ones, and it requires that the loans that it applies to have to be from after October of 2011. So if you're like me, you may not have loans from that time period. So this may not be an option for you. But certainly it's a great program, definitely something to consider. Also has a cap on payments, so you don't have to worry about the potential of down the road having payments that are completely unaffordable, or at least take away all of your disposable income. So pay was great. Pay was almost too great. So they came up with Repay, which is another repayment program that shares a lot of the characteristics of some of the earlier ones. So this is the revised pay as you earn. Again, it applies to direct loans, but it also applies to direct consolidated loans. So if you had some other types of loans, then you could consolidate them in to a direct consolidated loan, and then you would be able to get access to some of these programs. Again, it doesn't apply to the Parent Plus loan, and it has a 20-year payoff if all of your loans are coming from undergrad study, and 25 years, I'm sorry, it's 20-year payoff for loans coming from undergrad study, and 25 years until forgiveness for graduate study loans. Again, it's 10% of your income. It will require a partial financial hardship. Again, there's no cap on, but this one, there is no cap on the payment increases. So Repay was really created to try to capture all of those older loans that were ineligible for the pay program. And so part of the concession was, well, we will rope in all of these old loans, but we are not going to put a cap on what people's monthly payments can be. So again, this is something that you would really need to run your own numbers on to figure out, you know, depending on your career trajectory and what you anticipate that your income may be, is Repay going to become prohibitively expensive later on in your life? You know, when you actually don't really have a financial hardship anymore, and you're going to be paying even more than you would have under a 10-year standard repayment. The newest repayment program is new IBR. So it's new income-based repayment. Again, applying to direct loans, except for those Parent Plus loans. This one has the 20-year payoff. And again, they're using the 10% of income, but it does have the cap on the payments. So they tried to take some of the best parts of earlier programs and put them all together into a new income-based repayment program. This is, you know, kind of the highlights of all of the current federal repayment programs that are income-based. And on studentaid.gov, you can get every single minutia detail about each of these programs, and you would want to take a look at that before you decide, you know, which specific program is going to be best for you. I will say there are calculators on there to help you figure out what your repayment would be under each of the different scenarios. There's also there's like decision trees, especially on the CFPB's website, which you'll get a link to at the end of this PowerPoint as one of your resources to kind of help you figure out what is the best route to take. And I would absolutely suggest that you go through, you know, a couple of those before you make a final decision of what program is going to make the most sense for you. So, like we said, when we were going through the actual, you know, repayment option plans, there are things that you should take into consideration when you're picking your plan. Of course, if you're going to have a big increase in income, you're going to want to think about that when you're picking your program, and you'll probably want to pick something that either has a cap on the payments, or you're going to want to just be more aggressive about paying down your student loans so that you can, you know, get rid of them if you're not going to be able to have anything forgiven. So as I said, some of them do not have the caps on the payment, so you want to be paying attention to that. Secondly, tax filing status. It can become important because under some of these income-driven repayment plans, whether you file as an individual, as somebody who's married but filing separately versus someone who is married and filing jointly, can have a material impact on how much your monthly payment is for your student loans. And this is why I said at the beginning, it would be really, really great for you to make sure you're checking in with an accountant or your tax professional before you make decisions about changing your tax filing status just to get a better student loan payment. That might make sense for your situation, but it also may not. And we can't do the training on all of the different implications for changing your tax filing status. But just something to keep in mind that there are some programs, if you are married and filing separately, they will only take your individual income into account as opposed to including your spouse. Whereas for some programs like the Repay program, they don't care how you file. They're going to count your entire household income regardless of whether you file as married filing separately or not. So that's something to pay attention to. And last, tax liability. So we talked about, you know, the wondrous gift of having a balance of student loans forgiven at the end of a 20 or 25-year payment period. Yes, it is a wonderful bonus, and the IRS considers it income. So if you have tens of thousands of dollars of student loans that are being forgiven at the end of your payoff period, that forgiven amount is all going to be treated as income for that year, and income on which you have paid no taxes. So you're going to get a huge tax bill that year unless you are putting other strategies into place to try to prepare for that. Strategies such as saving money for your tax bill or, having a large tax loss in that same year that happens to balance out the boon of income. And this is exactly why speaking with a tax professional is so important when you're doing these kinds of strategies, to make sure that, you're going to be prepared. Nobody wants to get a huge tax bill at the end of 25 years that is more expensive, than if they had just paid off their loans in 10 years. But just something to keep in mind when you're going through all of these iterations of repayment options. And now, how to make your decision. Oh, Miss Jones' science class. This is not where you would do it. You would do it in your own home. This is how you can go about, making your decision on a repayment plan. First step, you're going to consider a 10-year plan and just figure out, is that too high for me? Can I afford it? If you can afford it, then you're going to be done in 10 years. And that's not bad. But generally speaking, they're often a little too high for people, especially, coming straight out of school. So use the resources that are available. There's the Repayment Calculator on studentaid.gov. And I am sure that there are, many other repayment calculators on there on blogs and on other, financial websites. A lot of people want to help you pay off your student loans and find the right repayment option for you. But the studentaid.gov calculator specifically will tell you exactly what your monthly payment would be under the different plans so that you can make an informed decision. Third, think about your future income and make sure that you consider that when you're deciding on what kind of payment plan is going to be good for you. Fourth, make sure you're taking into account all of those tax issues that we've talked about and considering your filing status and the future tax liability. And then finally, you're going to select your best program. It's going to be based on a mixture of current and potential future circumstances, which can sometimes be a lot to think about. But it's worth it, because if all you're doing is going for the lowest payment, for as long as you can, depending on what happens with your income, that could end up biting you. So you want to be trying to think through some of those things and being as strategic as possible. So before I move to private loans, Allison, I just wanted to touch base because I've been talking nonstop and I want to make sure I haven't missed anything in terms of questions coming in or other issues that have popped up while I've been going through all of the federal loan stuff.
We do not have any questions in the chat window, so.
Excellent, because it's so much information. But don't worry, if you guys want a copy of these slides, they will also be made available. You can drop your email in a direct message in the chat to me so that I have it, or you can send it to Allison when you're requesting the video of this recording so that you can have this information as well. So switching gears, repayment options for private loans. This is so much easier because it's not nearly as helpful. You have your standard repayment, which most private lenders offer. It's 10 years of fixed payments. And again, these payments can just be prohibitively expensive. So a lot of people don't necessarily go with the standard repayment. Again, because you're working with a private lender, there's all kinds of alternative repayment plans that you can set up. You can pay off your student loans faster than 10 years. They're not going to penalize you for it. They'll make sure that they wouldn't, but you can get a 5-year payoff plan, a 7-year payoff plan, or extend it as far as 30 years if you have, a mortgage-sized student loan debt. And it requires a mortgage-sized timeline to pay off. That's also an option with private lenders. Everything is much more flexible. And then lastly, there's also the forbearance and the deferment. Those are going to be options that are available either upon request or if you are able to show some sort of economic hardship. Under the federal programs, there's a lot of protections in terms of what kinds of situations, they need to give you forbearance or they need to give you deferment, with the difference being in forbearance, you are still paying the interest that accrues every month on your loans. So even though you're not making payments, the principal balance of your loans is going up every month. With deferment, that's usually based on economic hardship, and so the interest does not get added to the balance. You that's an added benefit for deferment. But this is all covered by the private lenders themselves, and they offer whatever they want to offer. So it's a conversation that you need to have with your specific lender to see what programs they have available and which ones would work out best for you. So let's talk about some better forgiveness programs than just having a balance forgiven with a huge tax bill. There's two main forgiveness programs for federal loans. One relates to teachers, and the other is the very popular public service loan forgiveness program. So with respect to teacher loan forgiveness, studentaid.gov, again, has all of the details on what the specific requirements are for this program, what kind of a teacher you have to be, what subject matters you can teach, what it means to be a highly qualified teacher, which is a requirement. But basically, there's a program where you can get $5,000 forgiven, and that's forgiven, not forgiven and you're going to get taxed on it. That is actually a straight out forgiven. But you do need to be a full-time teacher. It can be either, you do need to be at a low-income school or an education agency, and studentaid.gov has more information on exactly what types of agencies will qualify. The $5,000 forgiveness applies to both primary and secondary schools, but it does need to be 5 consecutive years of teaching. So, if that's something that you're already in the process of doing and you haven't considered this program, you just apply at the end of your 5 years of teaching. And if you've checked all the boxes, then, you'll get approved for the $5,000 forgiveness. For the larger $17,500 forgiveness program, it has all of the same, all of the earlier eligibility requirements, but it's only for secondary school, so high school, and only in math, science, or special education. So it's very narrow in terms of the subject matter that you can teach to be able to qualify for that forgiveness program. But the application process is the same. At the end of 5 consecutive years, you apply for forgiveness and they grant you the $17,500 or they don't. Public service loan forgiveness is a fairly popular program, and it's also gotten a lot of mixed press given how people's experience has been trying to actually qualify at the end of the program. But the basic tenets are you have 120 qualifying payments made while working for an eligible employer, and at the end of those 120 payments, which is 10 years, your entire balance is forgiven tax-free. So it's a very powerful program, and you just need to make sure that you do absolutely everything absolutely right. Otherwise, you'll get denied. So what does it mean to do everything absolutely right? First, you have to have the right kind of loan. So it has to be a direct loan. It can't be one of those earlier FFEL loans. It can't be a Perkins loan. It certainly can't be a private loan, right? These are only federal forgiveness programs. Secondly, you need to work for a qualified employer. There's a list on studentaid.gov of what employers qualify, but basically it's any government agency, 501c3s, and then certain public service jobs like law enforcement and I think some other public service positions, but there's a full complete list on studentaid.gov, and you want to make sure that your employer would be qualified before you assume that you're part of this program. Third, you need to be participating in a qualifying repayment plan. So when we talked about all of those income-driven repayment plans, those are the plans you have to be in. If you are in the 10-year standard, first of all, you're going to pay it off in 120 payments anyway, but that wouldn't be a qualifying payment. So if your first payment when you first got out, before you signed up for your income-driven repayment plan, was under the standard plan, that's not a qualifying payment. That doesn't count toward your 120. Also, if you were in one of the other alternative payment plans, the extended repayment, graduated repayment, those payments don't count either. So you have to be in the right plan for those to count toward your 120. Next, you need to certify annually. So this is how you'll know that your employer is eligible, and also that all of your payments counted. So you need to submit that employer certification every year and make sure that everything is still on the up and up, and that they know that you're making these payments every month to an eligible employer. And when you have your 120 payments, you've been working for the right kind of employer, you have the right kind of loan, you're in the right kind of payment plan, you apply for forgiveness and you cross your fingers and we hope that you get it. This program is not old enough to have a lot of data on how many people have actually been able to qualify for forgiveness, but it's just starting now. So if the Department of Education weren't inundated with all other kinds of issues right now, we might have a better sense of, how things are going with this for actual, the last step of forgiveness. But there is anecdotal evidence that people have had balances forgiven. So the program does work, but you do need to be following all of these steps and be very meticulous about your record keeping to make sure that all of these payments are being counted toward your 120. So a little bit more about, the specific eligibility criteria for the public service loan forgiveness. Like I said, the loans, it's only direct loans. So the direct subsidized or unsubsidized, the direct graduate, or the parent plus. So this is one where you actually can have the parent loans in there, and the direct consolidated. So we're going to talk about consolidation loans in a little bit, but that's a special type of consolidation loan for federal loans. Employers, like I said, any level of government is fine. So you can work at the federal level, you can work at the state level, you can work at the local level, as long as you're working for the government. And 501c3s also qualify. So definitely something to consider if you're going into nonprofit work, you're going to be there for 10 years. That could be something that is an eligible employer. And then those critical public service careers. So law enforcement and public defenders and some family and child services. That's a little harder to define than some of the other categories. So I absolutely suggest that number one, you go onto studentaid.gov to see if your family and child care service provider would be eligible. And then when you do the certification, you'll find out whether they're an eligible employer. And then for the repayment plans, as I said, the 10-year standard repayment, that's right, the 10-year standard, it does count. That's right, it does. It's the only other one that does. They really want you in that 10-year standard. And any of the income-driven repayment plans. So any of your payments that have happened under those two criteria absolutely qualify. But if you've been making payments under extended repayment or graduated repayment, those would not qualify. So other repayment options. A lot of people are interested in consolidation, and I want to make sure that we differentiate between the idea of consolidation versus refinancing. It's really just a difference between federal and private. Consolidation only puts a bunch of federal loans together now into a direct consolidated loan. There often is very little change in the interest rate. It really isn't something that you do to get a better interest rate. It's something that you do because you want to have one loan that you have to pay instead of, you could graduate with 6, 10, 15 different little loans that you've gotten over the course of your college career. And especially if you include grad loans, this consolidated loan means you'll have one loan to pay them all, and it's one payment, and it's just much easier for you to track and to keep track of. And with the direct consolidated loan, you will still have access to all of those federal repayment options. So if you remember, when we were going through all of different programs, all of them apply to direct loans, and a direct consolidated loan counts as a direct loan. But one thing to make sure that you're thinking about, if let's say you had your 6 different student loans, they were all federal loans, and you started making payments on them, and a couple years into your career, you just started thinking, oh my gosh, I need to clean up my finances. I just want to have one loan that I pay instead of these 6 different places that I have to go to every month. I don't like seeing all these bills coming in. If you get a direct consolidated loan at that point, and you've been making qualifying payments toward public service loan forgiveness, the consolidation will wipe out all of that history, because the direct consolidated loan is a brand new loan, and you have to get forgiveness on that brand new loan means you have to have 120 qualifying payments on that brand new loan. So we always want to caution people who have been very diligent with, trying to work toward public service loan forgiveness with a bunch of different federal loans. Before you consolidate, let's make sure you don't have qualifying payments that you would end up missing out on if you just kept everything separate. So just something to keep in mind. Refinancing is what you do for Your private loans in particular, though you can refinance federal loans, they just will become private loans. So you always want to be very careful when you get, you see advertisements or you get offers to refinance your student loans at historically low interest rates, which is kind of what we're living in right now. You will be converting any loans that you have into private loans. And once you go private, you can't go back. So you will lose access to all of those federal repayment options that we just went through and all of the other protections that you get as being having a loan with the U.S. Department of Education as opposed to having a loan with Citibank or Wells Fargo or Chase. And so you always want to think about, does it make sense for me to be refinancing? If you are really interested in paying off your loans as quickly as possible, refinancing could be a great option. If you get a bit lower interest rate and you're able to afford your payments, you're going to be paying less in interest over time. And that's a wonderful option for people. But you should know that you will no longer have access to all of those other really flexible and income-driven repayment plans that we've talked about. So just something to consider. But certainly a top consideration if you really are interested in paying off your loans as quickly as possible. You can get much better interest rates from private lenders than you will from the federal government. And like we said, when you consolidate with the federal government, they just mash all your loans together and give you some sort of average interest rate amongst all of them. So it's not an interest rates game with them. That's more just for, convenience. But with the private lenders, you can absolutely usually refinance for much better rates. So in these unprecedented times, there's all kinds of stuff going on around now about student loans and the relief provided by the CARES Act for student loans. And, the CARES Act applies to all federal student loans. And right now we're in a phase where 0 payments are due on student loans. No payments will be due from back to March 13th all the way through September 30th of this year. These $0 payments also count toward all of your forgiveness schedules. So if you're on the public service loan forgiveness 120 payment schedule, these months of $0 payments count toward your 120. Same thing for income-driven repayment plans. For your 20 or 25-year payoff schedule, these months count as payments. So, it's a great benefit for anybody who's in any of these forgiveness programs, and also, a great benefit for anybody who can't afford to make their student loan payment right now. Also, any automatically withdrawn payments that were made after March 13th of this year, you can ask for a refund. So a lot of people have their student loan payments automatically drafted out of their checking account. It makes it easier to pay. You're going to be paying on time. But if that was happening when, all of this COVID stuff started happening and people were losing income and places were closing, if you are in a position where you are either unemployed or you've had a loss of income and you really, really didn't want them to take that student loan payment out in late March or early April, you can get that money back if you need it. And you can just call them and they will send you a refund for it. So that's also a nice bonus, especially since people, need cash right now. And if they need it, they really need it. Secondly, with respect to interest, there's 0% interest on federal student loans until September 30th of 2020. All of this is being automatically applied. So you should see updates from your servicer when you go, if you are serviced by Nelnet, for example, and you go onto your Nelnet account, you should see $0 due and your current interest rate should say 0. So all this is being automatically applied. If you are interested in making payments toward your student loans, any payment that you make will first go toward any accrued interest that's on your account, but then it will all go toward principal. So if you're interested in, paying them off entirely, this is having 0% interest and being able to make payments 100% toward principal is a pretty cool thing, and it doesn't happen very often. So you've got federal student loans. We're in this weird period. Should you be making payments? Well, you need to ask yourself some questions because, of course, the answer is it depends. Are you working toward paying off your student loans completely? If you have no problem making your payments, then your entire payment is going to go to principal and it's going to get paid off earlier. You're going to pay less in interest overall. If you can afford it, go ahead and make your payments. If you are working toward forgiveness, don't give them any money. You don't have to give them any money. Keep your money. All of those payments are going to count. So keep your money, use it somewhere else. I'm sure you guys can think of something better to do with your money than send it to your student loan provider. The last question you want to ask yourself is, do you have a sufficient emergency fund? So you should have 3 months of expenses saved up. That's a really good cushion for you to have regardless of what might be happening. Even longer if you have insecure income, meaning that your job is perhaps in jeopardy or you have variable income that's been kind of, thrown off by COVID-19. If you don't have a sufficient emergency fund, don't put money toward your student loans right now. Bulk up your emergency fund. But if you do, and you want to pay off your loans, there's nothing wrong with making student loan payments. I'm not going to sit here and try to predict whether student loan debt forgiveness is ever going to be a reality. I can tell you if it is, it's only going to apply to federal loans. And if it happens and you've already paid off your loans, you've still already paid off your loans, so it's still not a bad position to be in. You just might lose out on some federal student loan debt forgiveness bonus. But the chances of that happening are certainly nothing that I can predict or even get into the potential of that happening on this training. But just know that if you're out of student loan debt, it's still pretty good. Private loans. Just in case you've heard this from anyone else, the CARES Act does not apply to private loans. It's just for the federal loans. So there is no special benefit through the CARES Act for private loan service providers. However, many student loan lenders are offering programs and offering relief to student loan debtors that they would not perhaps normally provide. So you just need to check with your specific lender because they will have their own relief programs. They will have their eligibility criteria. Oftentimes the eligibility criteria is literally checking a box saying, I'm affected by COVID-19, like everyone else in the country. So it's not really a high bar to get the relief. What you do, you may need to actually go through the steps. This is not going to be automatically applied. So you'll want to check with your lender about what's being offered, but you're also going to want to understand what the consequences are of whatever it is that they're offering. I highly doubt that there are any lenders out there who are offering $0 payments that count as though you made a payment and 0% interest, for any amount of time. What many of them are offering is some sort of, automatic forbearance where if you check a box and you say you're affected by COVID-19, they're going to give you a break on your payments. Nothing is going to be due for at least 90 days, but the interest will still be accruing. So they're not going to pay your interest for you. They're just going to tack that onto your principal. What you want to watch out for is that, for some reason there's a lender who wants to give you 3 months off of your payments, but then is going to require you to make those 3 payments in full upon the end of the relief period. Otherwise you'll be late on your payments. So you want to understand exactly what the consequences are. And those will be lender specific. And that will just require, just go on their website. But a lot of them have been fairly flexible and also fairly proactive in making sure that all of their customers that they're servicing know what programs are available and these programs are easy to access. So another analysis, I've got private loans. Should I be paying these during this time period? Just ask yourself, these basic questions. Can you afford it? That has to be the question all the time, but during this time in particular, because there's been so much economic uncertainty, think about, whether you really have a problem making your payments. And if you do, everyone is in forbearance right now. It's very easy to get into a program like that. And there usually isn't any economic, hardship threshold that you have to meet. So that could be a very good way for you to shore up your emergency fund during this time. Do you need good credit in the near future? One thing that goes along with the forbearance that is being liberally applied to student loan debtors is the student loan providers are putting a little note in your credit report that you have asked for forbearance. Even though it is part of a nationwide and global pandemic, they're still putting a note in your credit report. So that could give you a little ding on your credit score. So if you're applying for a mortgage in the next couple of weeks, or if you're applying for a personal loan, or you're trying to get a credit card or something along those lines, you want to think hard about whether it's worth it to take the credit hit just to get a little break on your student loan payments if you can still afford them. And also, there are going to be economic hardship deferments, which is different, as I said, than forbearance. So if you are unemployed or you have had a huge loss in income, you may qualify for a deferment. So the interest will not be accruing during the relief period. So it's an even more robust relief program that lenders will often make available to people who are in dire economic hardship. So you can also ask about that if you're both having trouble making your payments, and it's going to be really hard for you to deal with that extra interest that gets tacked onto your principal at the end. Student loan default. Oh gosh, we're getting close to 8 o'clock. So unfortunately, I'm going to try to get through student loan default as quickly as I can. It's a lot, but there are options available. These are all of the parade of horribles that would happen if you actually went into default on your federal student loans. It basically just means that you're 270 days past due on any of your payments. But the federal government is very serious about collecting on student loan debt, and that's why it can be very stressful for everybody. First of all, the entire unpaid balance of all of your student loans becomes due immediately upon default. You are not going to have access to any of the deferment or forbearance programs. You will not be able to qualify for any additional student aid. So if you went into default on some undergrad loans and you're looking to go to grad school, it's going to make it impossible for you to get any federal student loan aid. Also, damages to your credit report, all this stuff gets reported to the credit reporting agencies. When you're in default, the federal government will just send it to a collection agency for collection efforts. And those agencies charge fees on top of, your loan principal and the loan interest. And because they're collecting on a student loan, on a federal student loan debt, they often are not going to give you a break on those fees because they know that they can get the money. So it really is, it can become, even more expensive than it needs to be. Also, you can have your tax refunds withheld. So when you're waiting for your tax refund, after you filed and they just snatch it up to pay your student loans, they can go to your employer and start garnishing your wages. Also, there are many employers that require you to not have something that is, in collections. It could prevent you from going into law enforcement or other jobs that require a credit check. If you're in default on federal student loans, that can prohibit you from being able to get, the jobs that you're looking for. So if you're in default, and honestly, it's not always because you can't afford it, it's because you lost the loan and you moved, or you forgot that there was something you were supposed to pay. I have many clients who are in default, not because they are, economically unable to make the payments, but just because they got behind. And it's the last thing that they think about dealing with. But there are options, once you are in default. You can repay in full. If you have a tiny federal student loan that happens to be sitting in collections, it's $1,000, you can just pay it off and take care of it, and then it'll be done. That's the fastest way to deal with default, is to get rid of the loan entirely. We're going to talk about rehabilitation and consolidation as two other options. Rehabilitation is a longer road, but it does, so it brings your loans current. So you're going to go through a whole rehabilitation program. It's going to be 10 months of payments that you need to make. They're going to be income-based. But when you're done with that program, your loans are going to be in good standing, and it's going to be the ding on your credit report is going to be removed, which is a really big bonus for anybody who is looking, to improve their credit. Consolidation is the fast track to getting rid of default, but doesn't help your credit as much. So like we said, consolidation loan is a brand new loan. It pays off all of your defaulted loans in full, and then it lets you start payments fresh. But if you get a consolidation loan to pay off defaulted loans, they will stick you into an income-driven repayment plan. So you'll have to sign up for one of those with your consolidation loan. So here are, kind of the balancing factors for Rehabilitation versus consolidation, it's a lot of information. But like I said, rehabilitation, you're making 9 payments over a 10-month period. It's gonna be based on your income. It does remove the default from your credit history. So consider rehabilitation if you are actually gonna stick with the plan, because you can only do it once. And if you need good credit for something that's coming up in the next year. And also, once you've rehabilitated your loans, they're all current. So you have access to all of those income-driven repayment plans that we talked about earlier, at least any of the ones that your eligible loans would normally be eligible for. So you have a lot of options available to you. With the consolidation, like we said, there are 2 different ways that you can consolidate. You can the fastest track is to just take out a direct consolidation loan, pay off all of your loans in default, and then you have to go into an income-driven repayment plan. Or you can make 3 consecutive payments on your defaulted loans at their full payment amount, and then you can get consolidation. And if you do that, then you can repay in any way that you want. You don't have to sign up for an income-driven repayment plan. So consolidation, you want to consider if you are trying to get out of default quickly, you're sick of dealing with all these defaulted loans, and you want to have access to a variety of repayment plans, and you are concerned that if you need to spend 10 months under rehabilitation, something may go wrong and you won't be able to finish the program. So consolidation, it's one fell swoop and then you're pretty much done. So with respect to default, the CARES Act also has been providing some relief. The U.S. Department of Education has stopped all collection efforts, so you shouldn't be getting any calls or letters, or there should not be any actions against you with respect to collection. Also, there's 0% interest. So whatever loans you have in default, they still are being charged interest every month normally, but not now. They're at 0%, and that should all be automatically applied. All right, so resources for all the things that I've talked about today. You've heard me say studentaid.gov roughly 82 times, and that's because it is a really great resource. It's the first place that you should go if you have any federal student loans, or if you're not sure that you have federal student loans, because they will tell you if you do or not and where they are and what kind they are, so you can start thinking through these repayment options. Also, the Consumer Financial Protection Bureau is a wonderful government agency, and they have a really great website where you have basically they'll take you through a decision tree to figure out what you should be doing with your student loans, depending on what kind you have, what your income is, and things like that, so that you can try to make a better decision. StudentDebtCrisis.org is a nonprofit that is very interested in ending student loan debt, preferably through forgiveness, but in any way possible. So they have a lot of resources to help you understand the forgiveness programs, and they're written in layman's terms, as opposed to if you go to studentaid.gov, there's going to be a lot of technical language that you have to work through, but StudentDebtCrisis.org is wonderful. I've gone through a lot of their trainings. It's where I learned how to break this information down for you guys, so I absolutely recommend them. If you are interested in, or if you have a complicated student loan repayment situation, you can speak with a certified student loan professional. A lot of financial planners may have this as an additional accreditation that they carry around. It just means that they have studied student loans, they know all the different types of student loans, they know all about all of these repayment plans, and they'll be able to help walk you through something that might be quite a morass and a very complicated situation. They would be the most qualified to deal with it. And you can find a certified student loan professional through the CSLA Institute. And they have, a locator where you can find somebody who is near you. You can also speak to an accredited financial counselor. That's somebody like me. We pride ourselves on, number one, understanding your whole situation. It's an absolutely judgment-free zone. As I told you, I have my own student loans I'm still paying off. So we're just there to try to help you come up with the best plan. But also we always have your interests at heart, and that we've been through rigorous training and have taken exams. So I think that's important when you're looking for a financial professional, to make sure that you're working with somebody who really knows what they're talking about. And the AFCPE, who certifies the accredited financial counselors, is currently offering free financial counseling for anybody affected by COVID-19. So this does not have to do specifically with student loans. This is for anybody who's going through a hard time. So if there's somebody on this call, or if you know somebody in your community who is struggling, They have just started this program in connection with Wells Fargo and the Yellow Ribbon Network, which works a lot with military families and veterans. This is open to anyone. You don't have to be in the military. You just have to be affected by COVID-19. And you can meet with an accredited financial counselor virtually, of course. You can share information with them. They'll help you come up with a budget. They'll help you come up with an action plan. I'm volunteering for this effort. I can't guarantee you'll get matched with me, but you will get matched with somebody who has similar credentials to me. And special for people who attended this program, you can always email me at info@jessicamedinallc.com. You can check out my website to see what kind of services I offer in terms of individual coaching and counseling. But for anybody who is here today, if you mention this presentation, you can get a free 1-hour virtual session with me to discuss your individual questions, and we would go through your financial situation, and we would put together a plan that's going to work for you. And I'll turn it over to Allison.
Yes, thank you so much, Jessica. That was great. I learned things too because I am looking for public service loan forgiveness. So
it's a great program. If we can make it work.
But I did want to draw your attention, everyone, to these websites that are on our website, alexlibraryva.org. We do have many virtual events that are going on all the time on all kinds of different topics. So if you're looking for something to educate yourself or just to have some fun, we have lots of different kinds of programs going on. Also, we do have all kinds of digital resources, including books and audiobooks. So if you visit alexlibraryva.org/digital-collection, that will give you information about our ebooks, our e-audiobooks, our digital magazines, our free online courses, and more. So please do visit those if you are interested. And let's see, it looks like we do have something in the chat. Let me see. Oh, Teresa says, thank you, Jessica.
Oh, nice to see you, Teresa.
And as we said, we will be, we have recorded this session, so I'm not exactly sure how we can possibly share it through email. We might be posting it on our YouTube channel, but this will be available afterwards if you missed any part of it or would like to go over it again.
Oh, yes, and if you would like a copy of the slides, please send me a direct, in the chat, just send me a direct message with your email or send it to Allison so that she can send it to me so that I can share the slides with you.
Great. Okay. Thank you, everyone. And we hope to see you in the virtual world again sometime soon. And that will be all. So goodbye.
Thanks, everyone.